Good day, ladies and gentlemen, and welcome to our class on retracements and reversals. Now, it's very important to me that you subscribe to my channel, so I'd appreciate it if you could click below on the subscribe button or hit the bell icon, and we'll just notify you whenever I upload a new video. But subscribers are very important to me, and I promise you we're not going to barrage you with emails or bother you. So please click on the subscribe button and subscribe to my YouTube channel. It would be greatly appreciated. So let's get started talking about retracements and reversals. One of the most important concepts that you have to understand so that you can make smart trading decisions. Now, spotting retracements and reversals and knowing the difference is crucial. The ability to point out the difference between a retracement and a potential reversal is a great tool to add to your trading arsenal. Many inexperienced traders, along with some experienced traders, are still unable to detect the difference between an asset retracement and a potential reversal. Now, a retracement, and we're going to come up with definitions in a minute, retracements are healthy parts of a trend. If a trend moves straight up without retracing, it's got some serious problems. There's something driving it that's going to stop driving it sometime. It's like a child growing. He grows, he has a spurt down, he stops for a spurt. He spurts back up a little bit more, he eases, he spurts up. That's the way a trend works. Push and ease, push and ease, push and ease. So let's start out with a definition, okay? Retracements are momentary reversals that often occur during a longer trend. Unlike reversals, retracements show a continuation of an opposing trend within targeted assets price action. As you can see in the picture in the background, there are a couple retracements that take place and occur throughout a prolonged period of trading. Okay, so before we talk about a reversal, when we have price moving up, okay, it should push upward and then ease back down. Doesn't mean it's reversing, doesn't mean it's anything. What happens at some given point, buyers who entered a long position in an earlier phase have set up their take profit points and they've reached their health, their predicted target point, and they're selling their position. They've taken their profit, they're very happy. There's other buyers who are waiting to get in on that up movement who still think that trend is going to continue, but they're saying the price is a wee bit hefty at the moment. So they just move to the sidelines. They don't run away. They move to the sidelines. And when price eases down because all the sell-offs are gone and it eases down to a certain level, a certain price, we don't know what it is, the buyers who were sidelined saying, now it's a good deal, let's jump back in the market. And they start that continuation of the market upward. So imagine you have a hamster in a cage. It takes a lot of work for that hamster to start turning that wheel. Now, he runs at an even pace, going on, going. But if he stops to slow down, okay, that doesn't mean he's lost his motion. He can start it back up. He's going to take a breath. He may take some water, and he's going to keep it going. To stop that or reverse course takes a lot of work. Okay, so this is just to slow down while the traders are taking a gulp of water and grabbing their breath before they jump back in. Where reversals are temporary changes in assets trend that occur over a short period of time. Oftentimes reversals can last minutes, hours, or days. It just depends on what time frame you're utilizing for your charting solution. Reversals are oftentimes drastic and do not represent a long continuation of an opposing trend during the asset price action like seen in retracements. In the picture that we're going to see on the next frame, we can see what a reversal looks like. Now, actually, let me just pull you up a chart. And here's what a reversal looks like. Okay. Now, moving forward, is this a reversal or is this a retracement? Do we have an uptrend here, or do we have a continuation of the downtrend? You see, when we were moving up, it's a beautiful uptrend, And when we were moving up, we saw the push, the ease, the push, the ease, the push, the ease, the push. Now, we have to determine whether this mess here is a retracement or actually a reversal. Because a retracement will stay in the markets. A reversal, we want to get out of the markets. Now, there's some basic ways or definitions or ways that we can tell the difference. I don't use these. I believe you can see the difference on your price charts. But when it's a retracement, we see profit taking by retail traders, small blocks of trades. When it's going to be a reversal, when we think it's a reversal, we'll see where institutionals are actually selling or closing out large blocks of trades. We can monitor money flow. Okay. Buying interest declines, or if it's a reversal, there's very little buying interest because people are waiting for something. If it's a retracement, there are very few reversal patterns, usually very limited candles. When we're going to reversal, there are usually things like double tops, triple tops, triangle breakouts, patterns we can see on the price chart. In a retracement, there's really been no change in the fundamentals. Where in a reversal, we have some change or speculation in fundamental events that are coming up. Now, if we look at recent activity, it usually occurs right after a large gain. In other words, when it's a retracement, usually if price is pushed way up and had a big gain, and then it's easing back down and retracing a little bit. A reversal can happen anytime during any regular trading. Now, if you want to look for candlestick patterns, you might want to, in a retracement, look for an indecision candlestick, where in a reversal, you would look for engulfing patterns or soldiers patterns or other similar patterns. But again, I'm a firm believer that you can see it instinctively on your charts. Whenever a price reverses, most traders and investors are faced with a tough decision. You only have three options of what to do. You can hold throughout the sell-off, which could result in large losses if the retracement turns out to be a larger trend reversal. Sell and rebuy if the price recovers, or sell permanently, which could result in missed opportunity. The thing is, you have to be able to determine whether you're facing a retracement or a reversal. Now, today's traders have an expression for attempting to pick the very bottom or very top of a market. They call it trying to catch a falling knife. And as the expression implies, it can be downright dangerous and is not normally recommended. Okay. Now, retracements are healthy. Keep this in mind. So the retracement is the push up and the ease back down. When the price is easing, it is retracing. Now, one of the most popular indicators we use on this are support and resistance areas or Fibonacci retracement tools. And it said, a price will tend to retrace 38.2, 50% or 61.8% before recovering and moving back up. We have to decide how we're going to rate a retracement. Okay. Now, if you're looking at a trend and you say you're going to also rate it based on not reaching a lower low than the previous lower low, or a higher high and a higher low, whichever you might. Okay, I always want to look at my support and resistance levels. Price pushed up, it went through my resistance level, moved up, hit a support level, and retraced back down. I would expect it to retrace to the next support level and bounce off of it. But the market in general can become tired of moving in the same direction. It takes a lot of work and money to send assets to higher and higher prices. When the price gets too high, buyer pressure runs out. When the money dries up. When demand dries up, price begins to fall and causes the charts to head south. This causes security to become more appealing to prospective buyers who believe the asset has the potential to move higher, but we're waiting for a better opportunity. So what I've just described is a retracement. Retracements are healthy functions of a solid trend, and they are the proper time to enter a position on a trending asset. Now, you can see that the retracement of the asset was unable to push to a higher high. Instead, the security rolled over and created a lower high. A lower high is unhealthy, but is not the end of a bullish trend. It is possible that after setting a lower high, the stock may or could retrace again, never setting a lower low, and then push above the previous high to a higher high. The nail in the coffin of a bullish trend is the establishment of a lower low. Once the lower low is in place, your trend is over, and this is why it's called a reversal. So reversals are defined as a change in the overall trend of price. When an uptrend switches to a downtrend, a reversal occurs. Now, a lot of times, it's not going to flip over. Okay, you'll have an uptrend, it'll move into sideways congestion, total indecision, and you're waiting to see whether it's going to move up or move down. And if it moves down, it becomes an official reversal. If it moves up, it becomes a continuation. So what should you do? You're faced with only three choices. And I keep reiterating three choices. There's only three things you can do. If you're in a position, you can hold on to the position. And this is the crux, okay, is knowing when to continue on with that current position. Because you could close your position. So you're in an uptrend, it slows down and starts to retrace. You're going to get out of it a few points lower than if you would have sold at the top of that trend. But assets that tend to retrace, when they bounce up, tend to generate back to that trend and make a big gain. Okay, you lose that gain. Now, sure, you could sell the minute you start to see a retracement and then try to buy it back when that retracement's over and it becomes a continuation. Yes, you can. But between your spread and the missed opportunity, you might as well just walk away from the position. Okay. Two, you could have done the smart thing and set your rules of how you would determine whether you have a reversal or retracement. And then if you set by your decided set of rules, you can stay in that asset. You might want to shift your stop loss. And lastly, you could just close your position. That's the safest thing to do if you want. But then you're constantly closing positions with short gains. Now, you always have to be prepared. And my way of being prepared is moving my stop loss, cutting my potential risk, and especially if I made profit. I want to lock in my profit. And I can do this without closing my position. I can do this by changing my stop loss. Okay. Sometimes I'll even close out half my position and let the other half ride. Because if I made enough money to cover my investment and I'm just letting my profits ride, hey. So again, I'm going to ask you to please subscribe while you're listening to me. Thank you very much. Now, the following methods are popular use: Fibonacci retracements, pivot point support and resistance levels, trendline support and resistance, chart patterns, and other strategies. Now, Fibonacci retracements are excellent tools for calculating the scope of retracement. They are most widely used in the FX market, and they can also be used in the stock market. Now, fibs lay on your chart the specific retracement levels. Now, the most popular are 38 and 61, but 50 has been added in, even though 50% retracements are extremely popular, but they're not Fibonacci retracements. 50% retracements come from Dow theory. And now what is estimated is that an asset that has moved up a certain distance will retrace a certain distance when it's taking a breather. And the most common, like I said, is you saw this asset moving up, 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 up. We drew our Fibonacci's on. Here's your 50% retracement. This asset stuck right on that 50% retracement and then moved back up. So we would have seen it. 23.6 is a shallow retracement. 38.2 is a very popular one. And we could see price congesting around 38.2, but it's still tippled down to 50%. Okay. 61.8 is another one. Okay, I don't play with 61.8. If it, from my rules, once price has fallen 50%, I'm definitely out of that position. Okay. But look at this when it bounced off the 50. See, this is the gain you would have missed if you would have, say, sold here. You're never going to sell at the top. Let's say you got out of your position here because you started worrying it was coming down. Okay. You still made money, but look at what you lost. And what you lost is potential profit. But if you combine this with pivot points and support and resistance levels, you might have been able to make a smarter decision. You can also use trendline supports and chart patterns such as head and shoulders, triangles. So there's many ways to set up your understanding of whether you're looking at a retracement or a reversal. But this is part of what you have to build into your trading strategy and your rules for the trade, so that you're not sitting there blindly trying to figure out at the last minute or guessing what you do. So you should have a rule about if you're going to close 50% of your trade and you're going to take the profit depending on how much profit you made. You're going to move your stop loss up to what point. You're going to at what point close out your position. What point will you, like I said, I'll only ride it down and retrace it to 50%. That's me. Okay. You might want to ride to 71.8. There's people who buy at 78.6. 78.6, even if it was a reversal, is a great point to buy to continue back to that upward move, because they say the rule of thumb is an asset, when it moves up, when it eventually moves back down, will move down to 100% and then reverse course. But there's many ways that we can do this and build it into our trading system. But if you don't have it part of your system, then you're going to get lost. So just executing a trade, setting up a target point, a stop loss, and just sitting back and dreaming isn't a successful part of trading. Successful part of your trading and your strategy is exactly when you exit the market, how you would handle a retracement, because you don't want to lose your profit because you missed that retracement, because it could fall down to your stop loss and close you out. You had a significant profit and you missed closing your position. So you need to have what your warning signals are. You also can set up buy and sell alert signals. Like MACD is a great one. MACD will give you buy and sell positions in overbought and oversold conditions. They'll also help you see if that retracement is a trend shift. And then if you combine that with, say, Bollinger Bands will help you, because when you see the rejection from the upper band and when it breaks that moving average center line, that tells you it's shifted from a reversal or retracement to a reversal. So there are many different ways that you can trade. I even recently saw this ridiculous one that they called a sushi roll. I don't use it, but there's everything out there. People have come up with all kinds of strategies, and this is one that a guy just developed for himself, and he named it sushi roll. Okay, it's when price rolls up and rolls down. But there's all kinds of crazy stuff in the market, but knowing what you're dealing with and being able to tell whether it's a retracement or a reversal is very important. You can estimate retracement levels using technical analysis and place your stop loss just below these levels. Alternatively, you can place a stop loss just below the long-term support trend line or moving average. Ideally, what you want to do is lower your risk of exiting during a retracement while still being able to exit a reversal in a timely manner. So in conclusion, as a trader, you need to be able to differentiate between retracements and reversals. Without this knowledge, you risk many things, such as exiting too soon and missing opportunities, holding on to losing positions, and losing money and wasting money on commissions and spreads. By combining technical analysis with some basic identification methods, you can protect yourself from these risks and put your trading capital to better use. So thank you very much for joining us. And please, once again, I'll ask you to subscribe to my channel. And I love when people comment. So please drop in a comment or like my video. And have a great day. Bye now.